Welcome to this installment of Clarifying Tax Situations with attorney and CPA David W. Crossing.
Do I really have to report my cryptocurrency activity? Isn't cryptocurrency really anonymous? I can't tell you how often my phone rings with a potential client on the line that is really just wanting to know one thing from me. How, if ever, is the government going to detect my cryptocurrency trading activity? Do I really have to report this for tax purposes? Do I really have to get in compliance with the law? Isn't this stuff anonymous? How the hell are they going to know about me? Okay, well, here's my answer. The first thing that I'll tell you is there's a certain amount of anonymity involved with cryptocurrency. Users' identities are protected to a certain extent, but not entirely. It's true that Bitcoin and most cryptocurrencies advertise that they are anonymous. The simple fact of the matter is that this anonymity generally refers to the fact that people can send and receive money without directly revealing any personally identifiable information. Unfortunately, far too many people misinterpret this last piece of information to believe that once money is in Bitcoin, it is invisible to the IRS and the US government. This simply is not true. This faulty assumption by yourself, or if you're a preparer watching this, your clients, can lead to an audit, civil or criminal enforcement action. I'm here to tell you that Bitcoin and other cryptocurrencies don't really provide perfect or even reasonable anonymity in many scenarios. Let me explain. Bitcoin and most cryptocurrencies function through the use of a public ledger that contains all transactions ever conducted in that underlying cryptocurrency, and this information is publicly available. Frankly, there's no such thing as an entirely private Bitcoin or any type of cryptocurrency transaction. Not Ethereum, not Lite, not all. Any available anonymity stems from the fact that a user's identity is disassociated with the underlying publicly available information on the transaction. However, a record of the transaction time, the amount, and other information is always kept publicly available within the actual blockchain technology itself. The real problem exists with the government's use of John Doe summonses. There are other problems with detection, but let's focus on this one. When a user signs up with a popular cryptocurrency agency like Bitcoin, their identity is revealed in an email. That information is discoverable. For users that engage in Bitcoin transactions in this method, it is really no more anonymous or private than a banking transaction. You know what's really interesting to think about? That if I gave you a $20 bill, there would be no record of every other owner of that $20 bill. But if I give you a Bitcoin or Ethereum or Lite or Alt, every person that has ever owned that cryptocurrency coin is buried in the underlying blockchain technology. The only thing that's missing is a dissociation between the transaction and who owns that transaction. It's kept by a numeric key. Once that key is associated with a human being, every transaction conducted by that human being is discoverable. Matter of fact, there are companies out there that are blockchain mining for the US government to identify this type of information. Even if the government doesn't associate you with a cryptocurrency transaction through a John Doe summons, when you go to fiat on that cryptocurrency, it's impossible to hide. Number one, you may find out that your bank doesn't want to accept a deposit if they find out it's related to cryptocurrency. You may find out that if you sold $2 million Bitcoin through Coinbase, that they place a $10,000 distribution limitation on your funds and they distribute it out at $10,000 a day. When you start making those daily deposits into your bank account, you could run into structuring accusations because you're depositing less than $10,000 because of the transaction fees involved. You could run into suspicious activity reporting, money laundering by the banking institution that accepts those funds. And all of this information is electronically transmitted to the IRS. Even if they never look at you because of the obvious signs that you're involved with cryptocurrency, What happens if the return that you failed to report cryptocurrency is audited at any time in the next 3 open tax years? Or, God forbid, 6 open tax years if they discover anything that pries open a 6-year statute, like a greater than 25% understatement of income, or, God forbid, fraud. If they discover you're not reporting your cryptocurrency in an open tax year, and they believe you did that willfully, they can pry open 6 years to look at, okay? And I can tell you this, that's ripe for handing off to the Criminal Investigation Division for prosecution if there's large dollar amounts involved. And let's face it, there are large dollar amounts involved here. I have clients that have invested all of $100 in cryptocurrency in 2010 that now have a paper value of 1.9 million. I have another client that invested $100,000 at the beginning of 2017 that's worth $22 million. The growth in this stuff is absolutely insane. The amount of meat on the bone for the government to come in looking for their piece is a hell of a lot of motivation for them to come look at your filings, okay? You need to report this stuff, and you need to report it in the proper year. You can't just stuff it all in the year that you go to fiat, okay? You're gonna have to go back and pick it up in the actual year where you have a taxable transaction. If you mine Bitcoin, you gotta go back to the year you mined it and you didn't pick up the income. Subject to ordinary income tax rates, subject to self-employment tax. If you ever spent a Bitcoin, if it appreciated between the time you bought it and the time you spent it, that's a taxable gain. It has to be recognized in the year you spent it, okay? If you exchange cryptocurrency, okay, let's say you bought one cryptocurrency, you bought one Bitcoin for $5, and then you changed it into an Ethereum at a time when that was worth $10. Well, that's a $5 gain that has to be recognized in the year you made the exchange. Okay, if you conducted 1 million exchanges, it doesn't matter. Each one of those exchanges is taxable. And the worst part of these exchanges is it resets the clock to go from short-term to long-term. So if you hold something a week and then you exchange it, hold it another week, and you exchange it, hold it another week, you're never getting into the long-term capital gains rates by holding something a year before you sell it or exchange it.